Hi, I'm Jimmy. In this video, we're looking at stock buybacks, how they work, and if they're really a good thing for us investors. And what should we watch for if we're analyzing a company that is doing a stock buyback? Okay, let's jump right in. So ultimately, a stock buyback is when a company buys shares of their own company, generally from the public. Now, there are a handful of different ways to do a stock buyback, but the most popular method is known as an open market share buyback. And basically there, the company declares how much of the shares they're allowed to buy back, and then the company gets to decide when and if they're going to actually buy those shares on the open market. Okay, so this is the most popular method, so let's just assume that this is a method that's happening. This brings us to the real question is, are stock buybacks a good thing or a bad thing? Because clearly, they've been happening more and more in recent years. Now, this is the information that I could find from different sources. Some of them were conflicting, but this is, I would say, the average of what I could find. And the green bars, ultimately, I took from Goldman Sachs, and there was an article talking about they estimated that there would be $940 billion worth of buybacks in 2019. Now, broadly speaking, investors tend to like buybacks because generally buybacks are believed to increase earnings per share. Here's how. Let's pretend that a company has $5,000 in profits, and then they have 1,000 shares outstanding. Well, we take that 5,000 and divide it by the 1,000, and therefore they have an earnings per share of $5 per share. Simple enough. But let's say that the company wanted to buy back 100 shares from the public. Well, now there are only 900 shares outstanding. So the theory goes that we will have the same net income, so earnings per share will jump all the way to $5.56. Sounds like a pretty good thing. The stock price, in theory, should rise. So we know that with this formula, well, we know that shares outstanding are going to fall. That's the nature of a buyback. But the assumption is also that net income, it will stay the same, and that's not always true. Sometimes the buyback itself can actually make net income fall. To determine this, the first question we need to ask is, how is the share buyback being funded? Are they using cash that's sitting on the balance sheet, or are they borrowing money to initiate this particular buyback? Let's start with what it would be like if they were borrowing money. Well, at first, our thought might be, this is crazy. Of course, borrowing money to do a share buyback is a bad thing, but it actually depends on a few different things. So we have this same company. We're going to stick with our same example. This time, we're going to add a few details. The price per share to buy the stock on the stock market is $100 per share. Their profit for the past year is still $5,000, and earnings per share, we're going to bring it back to $5 per share. Same 1,000 shares outstanding. So one thing I'm sure many of us know is that if we take the price per share and we divide it by the earnings per share, we get the PE ratio. In this case, our PE ratio is about 20x. Okay, simple enough. But if we reverse this math and we take the earnings per share and we divide it by the price per share, well, we get what is known as the earnings yield. Another option would be to simply take the inverse of the PE ratio. So in our case, our PE is 20. So we take 1 divided by 20, you end up with, in our case, an earnings yield of 5%. So the key for us, and this is the important part, is that if the earnings yield is higher than the after-tax cost of debt, then earnings per share will move higher after a share repurchase with debt. But if the cost of the borrowing is greater than the earnings yield, then the earnings per share will actually move down after the share repurchase. Let me do a quick illustration. So the company that we're analyzing wants to buy back 100 shares. And since those shares are $100 per share, what's going to cost them $10,000? Now let's pretend that they want to borrow that $10,000. And the after-tax cost of debt is going to cost them 7%. Okay, fair enough. So their actual interest expense on that $10,000 will be $700 per year. That's how much they're going to have to pay in interest. That will reduce their net income by $700, bringing their profits now to $4,300 per year, 5,000 minus 700. But they also have less shares outstanding. So now they only have 900 shares outstanding. So if we take that 4,300, divide by 900, earnings per share actually fell to $4.78. That is simply because the cost of debt was higher than the earnings yield. Now, the earnings yield was 5%, so had the cost of debt been 5%, there would have been no change to earnings per share. What does this tell us? This tells us the price that the company pays is crucially important. If the company pays $100 per share, they have a 5% earnings yield. But if they were to pay $50 per share, they would have a much higher earnings yield. The same 7% debt would have been profitable for them because they would have got their shares at a better deal. Okay, now what if the company wants to use cash that it already has on its balance sheet for the stock buyback instead of debt? Once again, the same concept applies, although cash transactions can be a bit trickier to quantify. So let's take the very same earnings yield. So we have an earnings yield of 5%. So our question is, was that cash earning more than 5%, or did it have the potential to earn more than 5%? If it was, well, then the profits would fall and earnings per share would fall. But if it wasn't, well, earnings per share would rise. And that's really what makes this trickier to quantify with cash, because the company may not tell us what they were planning to do with that cash. Most of the time, earnings per share is going to get stronger with a cash buyback, especially when we compare it to buyback financed by debt. But are buybacks a good thing, assuming they're all cash buybacks? Well, clearly, there's only a few things that a company can do with its cash. They can do a share buyback, they can pay out a dividend, they can reinvest that cash into the company, or perhaps they can go ahead and make an acquisition. I think the real pushback with stock buybacks is that this implies that the company can't find anything better to do with the cash that they're buying back their shares with. In our example here, well, we have an earnings yield of 5%. And if the company can't earn more than 5% with that cash, sure, it makes sense to return it to the shareholders. But they could also return it in the form of dividends. Are dividends better? Well, it depends on the investor. Take Berkshire Hathaway as an example. Warren Buffett never does dividends, but he is willing to do stock buybacks every now and again. And a lot of the reasoning behind this is that he believes that his shareholders trust him to allocate their cash as efficiently as possible. And in theory, paying a dividend will simply put the responsibility back in the shareholders' hands to reinvest that cash. In my opinion, capital allocation is one of the most important things. It's one of the biggest responsibilities of an organization. Take our company as an example. It's trading at $100 per share, $5 in earnings. What if that $100 were to fall? The market would have crashed or something, and it fell all the way down to $25 per share. Well, now we have an earnings yield of 20%. Suddenly, a stock buyback is a very, very smart thing to do. They're getting a fantastic return on their capital they're investing in themselves. That would help all of us shareholders, assuming we all own a piece of this company. To me, that makes a lot of sense. So if the company can't find a good acquisition, or perhaps they feel that they have too much cash to continue to grow organically, so reinvesting it doesn't make sense, well, a dividend or a buyback could make a lot of sense. Now, personally, I'm generally a fan of buybacks. There's some tax advantages to it. You get taxed on dividends generally, and you might not in buybacks, although buybacks aren't allowed in all countries. But broadly speaking, a cash buyback can be quite useful to our company. So going back to our example for a moment, well, if the cash wasn't doing much of anything when they did the stock buyback, perhaps it was just sitting in a money market account or something like that, well, net income would stay broadly the same. Earnings, the shares outstanding would fall to 900 shares outstanding, and therefore earnings per share would jump by more than 11%. So we assume that the stock price would jump as well, but by how much? Now, one thing to keep in mind is leverage. So when a company does a stock buyback, so if we take the very popular financial leverage ratio known as debt to equity, well, here, let's pretend that we have assets of $50,000, liabilities of $30,000. Well, this will give us equity of $20,000. To calculate debt to equity, well, we take the $30,000 in debt or liabilities, and we divide that by the equity of $20,000, and we get a financial leverage ratio of 1.5. Well, once we do the buyback, well, assets fall because cash would have been spent. Assets fall by $10,000. Equity falls by $10,000. That keeps the balance sheet in balance. And our financial leverage ratio jumps all the way to 3, from 1.5 to 3. Now, I bring this out because companies with higher leverage tend to trade at a smaller PE multiple, all else being equal. So in theory, yes, earnings per share will jump, but that doesn't guarantee that the stock price is going to jump by the same amount. Our company was trading at 20x for a PE multiple, but that's when they had a debt to equity ratio of 1.5. Now that debt to equity has increased to 3, well, perhaps they won't trade at 20. Maybe they trade at 18 or 16 or 19. It depends on what the market is going for at that time. So at the end of the day, I like buybacks in certain situations, not broadly. I don't think that they should be used as much as it's being used right now. I'm not sure that every situation is appropriate for them. But what do you think? Do you think that buybacks are good at adding shareholder value? Do you agree with me that what we need to do is analyze each one in isolation and say, does this buyback make sense mathematically? Let me know what you think in the comments below. If you haven't done so yet, please hit the subscribe button. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.